November 2nd, 2022. The Federal Reserve raises interest rates by 75 basis points for the fourth consecutive time, the largest, most aggressive rate hike cycle in 40 years. And Jerome Powell stands at the podium, confident, resolute, telling America that inflation will be crushed, that the Fed has the tools, the expertise, the power. But here's what he doesn't say, what he can't say. The Federal Reserve just walked into a trap of their own making, a trap with no exit, no solution, no way out that doesn't end in catastrophe. And the worst part? They know it. Every economist at the Fed knows it. Every policymaker, every regional bank president. They understand the math. They've run the models. They've seen what happens next. And they're doing it anyway, because the alternative is worse. See, most people think the Fed's job is simple. Control inflation, manage employment, keep the economy stable. But that's not what they actually do. What they actually do is manage an impossible contradiction, a mathematical paradox that gets worse every single year. And in 2022, that paradox reached a breaking point, because for the first time in decades, the Fed had to choose: crush inflation and destroy the economy, or let inflation run and destroy the currency. There is no third option. There is no soft landing. There is no path where everyone wins. Someone is going to pay. The only question is, who? And that decision, that impossible choice, reveals something terrifying about how the modern financial system actually works. Something they don't teach in economics classes, something that makes every Fed statement, every interest rate decision, every confident prediction about the future a carefully constructed lie. Because the Federal Reserve isn't trying to fix the economy, they're trying to manage the collapse, to slow it down, to make sure it doesn't happen all at once, to buy time. But time is running out, and the trap is closing. So let me show you how we got here, how the most powerful central bank in human history became powerless, how decades of policy decisions created a debt spiral that can't be stopped, and why every move the Fed makes now, raising rates, cutting rates, printing money, tightening policy, only makes the trap tighter. Because this isn't about inflation versus recession. This is about a system that's been broken for years, a system held together by debt, monetary manipulation, and the belief that central banks can control markets forever. And that belief just shattered. Let me tell you about a number. $33 trillion. That's the U.S. national debt as of 2024. But here's what makes that number truly terrifying. It's not the size. It's the interest payments. In 2023, the United States paid over $880 billion just in interest on the national debt. Not paying down the principal, just interest. That's more than the entire defense budget, more than Medicare, more than any single government program except Social Security. And it's growing. Fast. Because here's the trap. When the Fed raises interest rates to fight inflation, they make everything more expensive to borrow, including for the government. Every new Treasury bond issued at higher rates, every old bond that matures and needs to be refinanced at higher rates, the interest burden explodes. And here's the cruel irony. The Fed raised rates to cool the economy, to reduce inflation, to bring things under control. But in doing so, they've created a fiscal crisis that forces the government to borrow even more. Because the government can't cut spending fast enough to cover those interest payments. Social Security? Politically untouchable. Medicare? Politically untouchable. Defense? Good luck cutting that. So they borrow. They issue more debt to pay the interest on the old debt, and the debt spiral accelerates. Now, you might be thinking, okay, but the Fed can just lower rates again. Problem solved. And you'd be right, except for one tiny problem: inflation. If the Fed cuts rates while inflation is still elevated, prices spiral out of control. The dollar loses purchasing power. Savings evaporate. The middle class gets destroyed. So the Fed is stuck. Raise rates, and you bankrupt the government through interest payments. Lower rates, and you destroy the currency through inflation. This is the trap. And it gets worse. Because it's not just the government that's drowning in debt. It's everyone. Corporations took advantage of a decade of near-zero interest rates to borrow trillions. Stock buybacks, acquisitions, leveraged bets, all financed with cheap debt. But that debt isn't cheap anymore. As rates rise, companies that were profitable at 2% interest rates become insolvent at 6%. Zombie companies, businesses that can't generate enough profit to cover their interest payments, are collapsing. Bankruptcies are surging. Corporate defaults are climbing. And banks, the institutions holding all this corporate debt, are getting nervous. Remember Silicon Valley Bank, Signature Bank, First Republic? They didn't fail because they made risky loans. They failed because the Fed raised rates so fast that their bond portfolios, full of low-yield treasuries bought when rates were near zero, became worthless. When depositors panicked and withdrew their money, the banks had to sell those bonds at massive losses, and they went under. That was just the beginning, because hundreds of regional banks are sitting on the same unrealized losses, billions in underwater bonds, waiting for the next crisis, the next bank run, the next panic. And the Fed knows this. They see the banking system teetering. They see the corporate debt bomb. They see the government's interest payments spiraling out of control. But they can't stop raising rates because inflation is still the bigger threat. Or is it? Here's where the trap gets truly diabolical, because there's a secret the Fed doesn't want you to know. A reason why they're actually okay with this impossible situation. A reason why the trap isn't a bug, it's a feature. Here's the secret. Inflation isn't the Fed's enemy. It's their solution. Let me explain. The United States has $33 trillion in debt that can never be repaid. Not with tax revenue, not with spending cuts, not with economic growth. The math doesn't work. So, how do you deal with unpayable debt? You inflate it away. Think about it. If you owe someone $100,000 today, that's a massive burden. But if inflation runs at 7% per year for a decade, that same $100,000 debt becomes worth half as much in real terms. Your nominal debt stays the same, but its real value, its purchasing power, gets cut in half. The debt doesn't disappear, it just becomes manageable. And who benefits from this? The borrower, the United States government. Who gets destroyed by this? The lender. Anyone holding treasury bonds. Anyone with savings in dollars. The middle class. Retirees. Foreign creditors. This is the hidden tax that nobody votes for. The silent transfer of wealth from savers to debtors. From citizens to the government. And the Fed knows this. They've known it for decades. Every major debt crisis in history has been solved the same way. Print money, devalue the currency, inflate away the debt. It happened after World War II, it happened in the 1970s, it's happening right now. But here's the problem. They can't admit it, because the moment they admit that inflation is the plan, the whole system collapses. Bank markets panic, foreign creditors dump treasuries, the dollar loses reserve currency status, hyperinflation becomes a real possibility. So they have to maintain the fiction that they're fighting inflation, the fiction that they're committed to price stability, the fiction that 2% inflation is the target and they'll do whatever it takes to get there. But watch what they do, not what they say, because what they're actually doing is threading a needle, keeping inflation high enough to erode the debt burden, but not so high that people panic, high enough to destroy your savings slowly, but not so fast that you revolt them. It's a controlled demolition of the dollar's purchasing power, and you're watching it happen in real time. Now, you might be thinking, but they raised rates to 5.5%. That proves they're serious about fighting inflation. Does it? Because here's what else happened. When those bank failures started in March 2023, what did the Fed do? They created a new lending facility, pumped $300 billion into the banking system, backstopped deposits, guaranteed liquidity. They were raising rates with one hand and printing money with the other, tightening and loosening simultaneously. And this is the trap's final form. The Fed can't actually let the system collapse. Too many banks would fail, too many corporations would go bankrupt, too much wealth would evaporate. The political backlash would be instant and catastrophic. So every time the system starts to break, they intervene, they print, they backstop, they bail out, which means inflation never fully dies. It can't. Because the moment they truly commit to killing inflation, they kill the economy, and they can't afford to let the economy die. So they're stuck in this endless loop. Raise rates to fight inflation, watch something break. Print money to fix what broke, reignite inflation. Raise rates again, watch something else break. Print again, over and over and over. Each cycle adding more debt, more instability, more fragility. Until eventually something breaks that they can't fix. And that moment is coming. Because there's one element of this trap that nobody's talking about, one group that's watching all of this with growing alarm, one force that could end dollar dominance overnight. And they're already making moves. Foreign creditors. Japan holds over $1 trillion in U.S. Treasuries. China holds $800 billion. The UK, Belgium, Luxembourg, major financial centers holding trillions more. For decades, they've been willing buyers of American debt because the dollar was safe. The Treasury market was liquid. The United States was the most stable economy on earth. But that calculus is changing fast because foreign creditors are watching the same trap unfold. They see the debt spiral. They see the inflation. They see the Fed's impossible position. And they're asking themselves a very simple question. Why are we financing America's deficit spending when the plan is to inflate away the value of our investments? It's a loan that's guaranteed to lose money. You buy a 10-year Treasury at 4% yield. But if inflation runs at 5–6% for the next decade, you're losing purchasing power every single year. You get your dollars back, but those dollars buy less. You've been robbed through monetary policy. And foreign creditors are starting to realize that they are the marks in this con. So they're diversifying, selling treasuries, buying gold, buying other currencies, reducing their exposure to dollar-denominated debt. And every time a foreign creditor sells treasuries, it creates a problem for the U.S. government because someone has to buy that debt. If foreigners won't buy it, who will? American investors? They're already overexposed. Pension funds? They're already loaded with treasuries. The Federal Reserve? Well, that's the nuclear option, and they've already used it. During COVID, the Fed bought trillions in treasuries, quantitative easing on steroids. They printed money and bought government debt directly. It worked in the short term, it stabilized markets, it prevented a collapse, but it also created massive inflation, the very problem they're now trying to fix. So they can't do it again, not without triggering hyperinflation, not without destroying what's left of the dollar's credibility. But here's the trap within the trap. If foreigners keep selling and the Fed doesn't buy, Treasury yields spike. Higher yields mean higher interest payments. Higher interest payments mean more borrowing. More borrowing means more treasuries to sell, which pushes yields even higher. It's a death spiral, and the only way to stop it is for the Fed to step in and buy, to print money, to inflate, which is exactly what they said they wouldn't do. So they're trapped between two catastrophes. Let yields spike and bankrupt the government through interest costs, or print money and destroy the currency through inflation. And foreign creditors know this. They understand that the Fed will choose inflation. Every central bank in history has chosen inflation because it's politically easier to destroy savers than to default on debt. So they're getting out, slowly at first, then faster. China's been selling treasuries for years. Japan just started reducing their holdings. Saudi Arabia is diversifying into yuan and euros. Even traditional allies are hedging their bets because they can see what's coming. A world where the dollar loses reserve currency status, where treasuries are no longer the safe haven, where America's ability to borrow unlimited amounts at low rates disappears. And when that happens, the trap snaps shut permanently. Because here's what nobody wants to admit. The entire American economic model depends on the rest of the world financing our deficit. We import more than we export. We spend more than we earn. We borrow to cover the difference. And we've been able to do this for decades because the world needed dollars, needed treasuries, needed to finance American consumption. But what happens when they don't need it anymore? When they've built alternative payment systems, when they've diversified their reserves, when they've reduced their dependence on the dollar? The trap becomes inescapable. The Fed can't raise rates without breaking the government. They can't lower rates without reigniting inflation. They can't print without destroying credibility. They can't stop printing without triggering collapse. And they can't escape. Because the trap was built over decades. Every bailout, every stimulus, every round of quantitative easing, each one adding another layer, another constraint, another impossible choice, until there are no good options left, only catastrophic ones. And the decision about which catastrophe to choose, that's coming sooner than anyone thinks.
So what happens next? That's the question everyone's asking, and the answer depends on which trap door opens first. Scenario 1. The Fed chooses deflation. They keep rates high, they refuse to print, they let the chips fall where they may. Corporate bankruptcies surge, banks fail, the stock market crashes, unemployment spikes. We enter a deflationary depression that makes 2008 look mild. But here's the thing about deflation. It makes debt more expensive in real terms. When prices fall, the burden of existing debt grows. That $33 trillion national debt becomes harder to service, not easier. Tax revenues collapse as the economy shrinks, the deficit explodes, and suddenly the government can't even pay the interest. Defaults becomes a real possibility. Not a technical default, an actual, honest-to-God sovereign debt default. The United States of America failing to pay its obligations. The Treasury market, the bedrock of global finance, collapsing. It would be the end of dollar dominance, the end of American financial hegemony, the end of the post-World War II economic order. So the Fed won't choose deflation. They can't. Which brings us to scenario 2. The Fed chooses inflation. They cut rates, they restart quantitative easing, they print whatever it takes to keep the system alive. And inflation roars back. Not 3%, not 5%, double digits, then higher. The dollar loses purchasing power at an accelerating rate. Savings evaporate. Fixed income retirees are wiped out. Anyone holding cash gets destroyed. But here's the insidious part. The government's debt becomes easier to manage because they're paying back old loans with newly printed worthless dollars. It's a transfer of wealth from creditors to debtors, from the people to the government, from savers to borrowers. And it's politically survivable. Because most people don't understand monetary policy. They see prices rising and blame corporations, blame price gouging, blame supply chains. They don't blame the Fed. They don't see the inflation tax for what it is. So the government can inflate away the debt while pointing fingers elsewhere. It's the path of least resistance, the path every heavily indebted government in history has taken. And it's the path the Fed is already on. But here's the problem. Once you start down the inflation path, it's hard to stop, because inflation creates expectations. Workers demand higher wages to keep up with rising prices. Businesses raise prices to cover higher costs. The wage price spiral begins, and suddenly moderate inflation becomes high inflation. High inflation becomes hyperinflation. The currency loses credibility. Foreign holders dump dollars, reserve currency status disappears, and America joins the long list of empires that debased their currency into oblivion. Rome, Spain, Weimar Germany, Zimbabwe, Venezuela. Different eras, different governments, same ending. So those are the two doors: deflationary collapse or inflationary destruction, depression or currency crisis. And the Fed is trying to find a third path. A narrow corridor between the two catastrophes, where they can keep inflation around 3 to 4%, high enough to slowly erode the debt, low enough to avoid panic, where they can keep the economy growing, but not so fast that it overheats, where they can manage the banks, manage the government finances, manage public expectations, all at the same time. It's an impossible balancing act, and the margin for error shrinks every day, because the debt keeps growing. The interest payments keep rising, the financial system gets more fragile, and eventually something breaks that they can't fix. A major bank failure, a treasury auction that fails, a geopolitical crisis that sparks capital flight,
a recession that forces their hand, the trap will close. The only question is when, and what you do about it determines whether you're a victim or a survivor. Because here's the truth they don't want you to understand. The Federal Reserve can't save you. They can barely save themselves. They're trapped in a system of their own design, managing a crisis they created, trying to postpone a reckoning that's inevitable. And when it comes, when the trap finally closes, your dollars, your bonds, your faith in the system won't protect you. Only real assets will. Things that hold value regardless of what happens to the currency. Gold, land, productive businesses, skills, relationships. The things that have preserved wealth through every monetary crisis in history. Because the Federal Reserve trap isn't just about central banking or monetary policy. It's about what happens when a financial system becomes so complex, so leveraged, so dependent on continuous intervention that it can't function without it. And we've reached that point. The Fed can't stop managing, can't step back, can't let markets clear. Because the moment they do, everything collapses. So they're trapped, managing the decline, trying to control the uncontrollable, pretending they have answers when they're just buying time. And you're watching it happen in real time. Every Fed meeting, every rate decision, every pivot and reversal. It's all just moves in a game that's already been lost. The trap has closed. They just haven't admitted it yet. And they never will. Because the moment they admit the system is broken, it breaks completely. So they'll keep pretending, keep promising soft landings, keep insisting they have the tools, keep lying, until the math catches up, until the trap becomes visible to everyone, until there's no denying what's been true all along. The Federal Reserve doesn't control the economy controls them. And the trap they built to manage the system has become the system itself, inescapable, inevitable, already closing.